Good evening, everyone. Welcome to the DLP Q1 Performance and Virtual Dinner event. We appreciate everyone taking some time out of their evenings to join us. We have a fun-filled night packed with a lot of information and highlights on the company. We look forward to breaking some virtual bread with you. Hopefully, those of you at home received your certificates for Grubhub and are enjoying a little bit of a meal on us. We want to give you a little bit of the night tonight. We're going to really go through giving you a bunch of information. Don's going to present for us, but we're going to be taking Q&A. So type those into the chat box. Larry Hickernow is joining us as well. He's behind the scenes right now, setting a lot of things up, taking information. So again, we'll be answering your questions live at the end of the presentation. So keep those questions coming in and we'll answer them. In the interim, I just want to turn it right over and get us started so we're not delaying. We want to do a little virtual toast with you, but I take pleasure and the honor in introducing our CEO and founder, Don Wenner. Don, thank you.
Appreciate it very much, everybody. We'd love to toast all of you. Welcome. Thank you for being here with us tonight. Looking forward to providing some great content, insight, and hopefully some fun as well. So cheers.
So good Q1 and many more to come.
All right, everybody. So as Rich said, we're going to talk a little bit about, as we're calling this, results with impact. We're going to tell you about a little bit how Q1 and how we're doing so far this year, and what's ahead. So without further ado, here's our little friendly, I like to say, Barry disclaimer here, our Chief Legal Counsel. So overview, as Rich said, I'm going to tell you, for those new, and we have hundreds with us here tonight, as you can probably see. So many of you are existing investors and know us very well, but we have plenty of guests here who are new to DLP. So we tell a quick bit about DLP. We're going to kind of dive quickly into the DLP Housing Fund, our billion-dollar flagship fund, and pretty exciting things to share there. And then we're going to kind of take a focus on some of the crises we're facing here in America today, and that we're specifically focused on here at DLP, and you as investors with us are helping make an impact on. And then we're going to talk about how you can prosper, some of the cool things we're doing, the upcoming event we have coming that I know many of you have already registered to join us. And then, as Rich said, we'll open it up to any and all questions. So please type those in as I chat with you here this evening. All right. So first overview for those new to us, this is a little slide that gives you a scope of DLP. So on the left, you see DLP Real Estate Capital. That's our parent company. But at the very top, you see DLP Capital Partners. That's our investment management, fund management business that many of you are invested in. And that is the engine here at DLP. That's what allows us to do everything we do, offer all these solutions that we offer to residents, to investors, to homeowners. And we do that through the various DLP arms, as you see on the screen, from DLP Realty to DLP Lending to real estate management, which includes asset management and construction management and development. And then our very unique and growing DLP Prosperity membership you'll see on the right, which I'm going to be talking about in just a couple minutes. Our mission here at DLP is to lead and inspire the building of wealth and prosperity with our partners through relentless execution of innovative real estate solutions. We do that with your help and by being centered around these 10 core values you see on the screen at the top and the bottom. One of the ones we think is most critical to you as investors and potential investors here at DLP is at the top right, stewardship. Here are the leaders at DLP. You just met my associate Rich, who I'm going to do another little formal intro on in a moment. Larry, behind the scenes with us here tonight. Bob and Barry, our partners and chief financial officer and legal counsel. I just noticed Barry's description says CEO and founder. If he's watching, which I'm sure he is, he's got a little nervous there, but he's our chief legal counsel. And then Bo, who's our chief growth officer, helping and brought many of you to us here tonight. This is the team, though, that matters most to many of you, as they're the ones driving results, providing you great service, making sure your distributions and reporting get out on time. And producing these great presentations and events that you're joining us with here tonight. So a quick bit about myself. I started DLP, or what became DLP, over 15 years ago now. Since then, have now closed. We just passed the 20,000 transaction mark for over $5 billion, including over $2.5 billion of acquisitions and over $2.5 billion of lending. And those are essentially our two core businesses, acquiring properties and making loans to others to acquire and improve properties. Today with you, we own over 12,000 residential units. I'm the recent author of a best-selling book called Building an Elite Organization. I'll touch on a little bit more in a moment. And we've won lots of awards for the great culture and organization that we've been able to grow with your help over these last 15 years. I always tell myself, and I don't get to give enough credit, some of the great leaders who you guys have come to know, and those of you who haven't yet. I'm going to first introduce my associate Rich, who was just up here, and tell you a little about Rich's accomplishments here at DLP. So Rich has been here now just over 2 years with DLP. It feels like about 15. It's hard to remember when Rich wasn't here, but he was our first ever managing director. He's led our institutional and wealth partner due diligence, including our recent deep dive due diligence report done by a firm called Conway, which we're glad to provide out to all of you. He's helped us bring on 3 leverage facility partners. That's helped us increase our returns and provide access to more capital across our lending strategy, over $300 million, help bring in capital to fund our new construction arm of our business. And he's helped us bring our servicing book, loans we serviced over here at DLP, to over $300 million, which is small compared to his past experience with over $500 billion in servicing book experience. And he's excited, I know, to help us grow our balance sheet as we've been doing rather quickly. He led our Positive Returns Foundation silent auction that we hosted last month, or I guess late March, in St. Simons Island. Thank you so many of you for your support. And he is one of our best culture ambassadors here at DLP Real Estate Capital, and leads a 5 a.m. workout group here at DLP, and has been doing so every day for over a year now. And an amazing leader across the organization, certainly here for our investors and DLP Capital Partners. Larry Hickernow is our Senior Director of Investor Success. That's a recent promotion. Congrats, Larry. And he actually was our first ever Investor Success Manager. So up until Larry, I was the only person working directly with our investors. At the time, we had around 400 or 500. Larry came in, freed me up quite a bit, increased the quality and level of service we provided, has built our Investor Success Management team, has implemented our inner circle that many of you are a part of. If you're not, we'd love for you to learn about it and become a part of it. And he's helped us go from where we were at. I guess I thought we were even more than we were at when Larry came. I guess we're about 200 when Larry joined as investors. And as you'll hear even more about, we now have over 1,500 investors here at DLP. He's brought in over $200 million of capital here at DLP. He was voted DLP's Martian Award winner, the team member who most exemplifies DLP's core values. He leads our Miracle Morning Prayer Group, fellowship group, alongside some of our other senior leaders, including my father. And everybody here who knows Larry understands the level of passion and energy he's brought to DLP now for the past 5 or 6 years. So make sure to give them some kudos here. I get a lot of the credit for our success and our growth and what we do, but these leaders certainly deserve a lot of the credit as well. So what myself, Larry, Rich, and the rest of DLP do, who we are, is we are impact investors focused on the affordability crisis of workforce housing throughout America. We invest in providing, preserving, and creating workforce housing communities that are affordable for working families. We invest as an operator, as an equity partner, and as a lender. In addition, we manage, lease, source, sell, close, and service these investments in workforce housing communities across America with a focus on the Sun Belt, as you'll see more of it when I show you a map in a few moments. Who we are by numbers, you see here on the screen. We provide loans right now, over 700 loans to real estate operators, builders, and developers. We own over 12,000 rental units. We are now at $1.4 billion in assets under management. It was just the second half of last year that we hit the $1 billion mark, actually August of last year. We did over $160 million of annual operating revenue last year. We provide housing to 30,000 residents. We have 416 team members as of this morning. I heard that'll be 430 by next week. We have 42 communities that we serve and manage, providing funding and capital and support and education to more than 200 real estate operators. And as mentioned before, over 1,500 investors. It was July of last year that we hit our 1,000 investor mark. We've had 500 investors choose to invest with us, many of which referrals from you since then, which has been unbelievable and astounding. This is where we operate. So top left, you see our Bethlehem, Pennsylvania headquarters. I'm talking to you from that building that says Florida headquarters. And I'm proud to announce to all of you that that'll only be our Florida headquarters for a few more weeks, as we have officially outgrown our office here. And we actually just went under agreement and hard on a 70,000 square foot headquarters down the road, which we're pretty excited about. We are renovating that building on the right to become our regional headquarters in Asheville, North Carolina. And then we have hub offices in St. Augustine Beach, Poconos, Daytona Beach, and in Asheville, North Carolina. All right, so enough about DLP. Let me tell you a little bit about, enough about who we are. Let me tell you a little bit about what we did in Q1 and what's happened in the world of real estate here. So Q1, we raised over $100 million of capital, deployed that into 225 loans for over $141 million, biggest quarter ever, in addition to 40 lines of credits for $265 million. We won lots of additional awards, lots of recognition here in the past few months, including 175th fastest growing company in all of the Americas just last week. As mentioned a couple of times, 1,500 investors, and we feel it's worth mentioning one time again. This is a huge milestone here at DLP, one that we don't take for granted, and we take as a major responsibility for all 400 of our team members to take care of the 1,500 families, investors who've entrusted a portion of their wealth and capital here to DLP. In Q1, we welcome some really amazing team members here. Here's 4 of them that are important to all of you as investors. Bonnie, our Chief Marketing Officer, Jim, our Head of Asset Management, Taylor, a great addition to the investor capital team. Many of you have already met him. And Shannon, our new Area Vice President, Property Management. We've added so many amazing people here in Q1 already. April, we've added many great leaders and team members. In fact, we had 23 team members in the month of April and over 30 so far here in the month of May. Some other great new leaders have joined us, including Jim Boyce, our Head of Development, Paul, SVP of Construction, and Jack, SVP of Marketing. You'll see, and we'll introduce many of those in our upcoming reporting and highlights as well. All right, so let me tell you what's happening in the market. Everybody knows the real estate market's hot right now, but I don't think everybody realized quite how amazing it has been. So as of the end of Q1, home prices, average listing price was up 15.6%, which correlates pretty much to a 15% increase in the average price in 1 year. 15% climb nationally to $370,000, the average median home price the end of Q1. Homes are selling 10% faster than a year ago, which they were already selling at record paces, on average now to just 54 days. The supply of housing, which was already at all-time lows, has declined by 52%, meaning there's simply not enough supply to keep up with the demand today. Interest rates have stayed very low with a very small uptick, but still, as Jonathan Campbell, our Head of Realty, commented this morning, it's actually still more affordable to own a home today than it's been at virtually any other point in the past decade because of these incredible low interest rates, which continues to drive this incredible demand. When it comes to rent and occupancy in the rental market, vacancy rates went up just slightly in Q1 from a year ago, but it doesn't really tell the whole picture. As you continue to read there, in Q1, Class A increased by 0.84% in terms of the average rent. The average rent in Class B went up 2.2%, and in Class C, most affordable sector, went up 8.1%. And the same trends are there when it comes to vacancy rates. Class C actually had a decline in vacancy rates. Class B had a decline in vacancy rates. Class A had a slight increase. The demand for affordable workforce housing, what we invest in, has never been higher. In addition, even despite the COVID moratoriums, we've seen delinquency go down. In fact, we ended at 4.4% in rent delinquency as of this past month, bringing us down much closer to where we were, where we expect to be in a non-COVID moratorium world. Best point we've been at since COVID started over a year ago. Property values continue to climb on the investment side. Both single-family and multifamily investment properties values are climbing. Cap rates are declining. Demand for workforce housing, for multifamily housing as a whole by investors has never been higher than it is today. Supply is incredibly constrained, as mentioned before. You see that little chart that's just showing the amount of homes on the market, and you see it drastically declining over these last number of years very, very quickly due to the incredible demand on the market today. We expect, as we look ahead, even though property values went up 15% this past year, we never projected that great of a growth. We always want to be conservative in our expectations, and we believe we're very conservative in our expectations that prices will continue to climb by at least 3 to 5% over the remainder of 2021. We expect supply to continue to remain incredibly constrained at these all-time record lows. We expect homes to continue to sell even faster than they already have been due to this incredible demand and low supply. We expect rent growth to continue and to be positive across many asset classes, but certainly here in the multifamily sector and certainly in the workforce housing. We expect delinquency to continue to decline and interest rates and cap rates to remain incredibly low values to continue to climb on investment properties. So it is an absolutely incredible market. I feel like I said so many things that it sounds like I must be exaggerating to say all-time highs, never been better. Markets are great, but this really is just been an absolute astounding market when it comes to housing. It is hard to I think comprehend how incredibly hot and aggressive this market has been here this past year. And what's amazing is it's driven by some incredible fundamentals. Here at DLP, we believe that real estate, and coming off telling you how great real estate and especially housing has been, we believe, and this will lead into some conversation on the upcoming event I want to tell you about, we believe real estate is a staple investment. We believe, and we know factually, that most of the wealthiest families in America and around the world have their largest percentage of their portfolio in real estate. And we believe real estate is one of the four staples. It's real estate, it's fixed income, it's equities, which includes public and private equities, and cash. And that's how you look at investments. And that's the more simple approach and more balanced approach, we believe, that we want to teach and explain asset allocation to our many investors at our upcoming Prosperity, Family, Wealth, and Legacy event, which is July 8th to the 11th in Asheville, North Carolina. We already have over 60 couples signed up joining us. We expect to have over 100 couples joining us for a jam-packed a weekend of a lot of fun, but a lot of education and a lot of progress on living and leaving a legacy. And we welcome you to apply there. You see the link. We'll email this out to you again as well. DLPcapitalpartners.com. We'll drop it in the chat box /Asheville. And some of the things we're going to be covering at this event is one of the foundational reason to why we started this membership and these events was around what you see on the left there. That 70% of wealthy families, first generational wealth creators, have their wealth lost by the second generation. Many of us, despite all our hard work, will have our wealth gone in a very short amount of time. And we believe that doesn't need to be that way, and that there's a number of reasons for that. Some revolve around financial decisions and planning. Some is around involving your family in education, involving them in understanding why you built the wealth, what it's meant to solve, and being on the same page with the impact you want to make. So at these events, we're focused on will and estate planning, portfolio defense, which is a blast and really help you to take a deep look into what you want to accomplish in your life and your wealth and your portfolio and your family. Philanthropy, expert sessions, amazing speakers, which I'll highlight some of, one-on-ones with myself and our leaders. We're going to help you answer questions like why are you prepared to leave a legacy? Are you living that legacy today? We believe it's about living and leaving a legacy. Is your will and your estate up to date? Is it prepared for the impending tax changes? Do you have a trust in place? Is your family aligned? Do you have clear direction for what you want in your family? Do you have deep relationships with your children? Do you have a family mission? Think about that. Do you have a family mission? Have you ever given that deep thought? Do you have a purpose for your family? Are you living fully? Are you making an impact? Do you have a clear giving policy that's allowing you to make an impact? These are the questions that we're going to help you answer and take deep dives into over an amazing time in Asheville, North Carolina in just a couple months. My good friend Hal Elrod, who happened to be wrote the foreword for my book and wrote a very famous and incredible book called The Miracle Morning, will be one of our keynote speakers. We have Oz Perlman, who's an amazing mentalist, incredible. Look him up on YouTube, online. You're going to be blown away. And some other outstanding, incredible, best-selling authors, world-class speakers. It's going to be an amazing weekend. So to learn more, reach out to one of your investor success managers or go and apply to join us on the link you see there. We'd love to have you. It's going to be a blast. All right, so let's dive into the investments and what we're doing here at DLP. So first thing I'm going to talk about is the DLP Housing Fund. This is our billion-dollar evergreen REIT that we launched about a year and a half ago now. We're focused on providing housing to 250,000 residents through 100,000 affordable workforce housing units. We're up to 6,600 units in the fund today and making tremendous progress as we acquired 2,000 units in Q1 alone. We're focused on providing great, safe, affordable housing to working families, primarily in secondary and tertiary markets throughout the Sun Belt. Multifamily has been one of the strongest and most stable asset class to invest in, not just since COVID, but over many, many, many years, over the past many decades. Over the past, as you see this note here, over the past 25 years, multifamily investment has been the highest average returns of any commercial real estate asset class. What we're focused investing on specifically, though, is improving, preserving, and creating housing that is affordable for the local workforce. What that means is we target communities where the rents are less than 30% of the area median income in markets that have good population and job growth. So we want to make sure our apartments are affordable, meaning our families aren't having to spend more than 30% of their income on rent, meaning they're going to have to sacrifice on education, healthcare, food. I mean, the basics that you can't afford when you're spending more than 30% of your income on rent. Primarily, we're buying 1990s plus construction, 200-unit communities, where we can generate over a 7% yield to our cost, unleveraged cap rate on our investments. We do this. You see some of those little markers here on the screen. These are where we own communities today. You'll see lots of those marks throughout the Sun Belt Southeast region. As mentioned before, we have 6,600 units now across 25 communities, over $600 million already in the fund. And I'll tell you how we performed in year one in just a few minutes. This is an evergreen REIT, open-ended, meaning we expect we're going to grow and run this fund for decades. We provide annual valuations to our portfolio. The fund is incredibly tax efficient. It's one of the most tax efficient investments you can invest in. And we provide monthly distributions while giving you the ability to choose when you want to exit the fund. You can exit the fund each year in part or in whole and choose when you want to have a taxable event based on what works for you and your family. We're able to, despite this incredibly demanding market with so much capital chasing this space, we're able to still mitigate risk and generate above market returns through first mitigating risk. We do significant due diligence, thousands of hours of due diligence on every one of our acquisitions. We stay very focused on the value, finding opportunities, finding market inefficiencies that when you're in tune with the market, you have enough people focused, in touch, building deep relationships. There are market inefficiencies. It is not a perfect market. There are many opportunities, and I'll be showing some of those recent opportunities here in just a moment. We invest in assets that we can produce great cash flow, 10% cash on cash returns, assets that produce 17+% IRRs using very conservative expectations. We're not assuming what's been happening is going to continue to happen in terms of rent growth, in terms of values. We put in long-term non-recourse financing. We do active hands-on management. We retain our residents. We tackle deferred maintenance, emergency and critical items. We keep our apartments affordable all at the same time. Our performance through COVID has been, we've been able to keep our delinquency around 6.5%, higher than we'd like, but considering the moratoriums and what we faced, we're proud of it and have now declined to under 5% delinquency. Our cash flow and our occupancy have never been higher. They've grown month over month through COVID, and we've been capitalizing on these incredible low interest rates to put long-term debt in place that allows us to, again, continue to maximize our cash flow. In Q1 alone, we acquired 7 properties, 1,934 apartments for $229 million. This is our most recent acquisition. You might think this does not look affordable. It is. This is a brand new construction community in a suburb of Memphis called Germantown, where the FedEx headquarters is. Very affordable. Affordability of about 21%, meaning the average resident is only spending 21% of their income on rent. So a $9 million investment. Right before that property, we acquired 4 communities throughout Mississippi and Alabama. Average rent of $866 to $970, depending on the community, in the mid 900s average rent. Affordability of just 22%, despite these being very nice, well amenitized, well kept assets, as you can see here in these pictures. We also in Q1 acquired 2 communities in Kentucky, in Owensboro and Paducah, Kentucky. These are 2014 and 2016 construction communities with an average rent of about $860 a month. Average affordability of around 21%. You see some of the pictures and some of the highlights here of these beautiful new communities and great new team members that have joined DLP. Those communities were a $20 million equity investment. And next up, we're acquiring a community in Oxford, Mississippi called Lafayette Place. This is a property today that's a student housing community. And we're going to open up this property to both students and non-students, which will allow us to maximize our returns, maximize our occupancy, and provide the best value to this community. Well amenitized property built in 2009 that we're buying at about a 50% discount to the construction cost. Incredible opportunity due to the COVID-related student housing challenges. In addition, coming up here, we're acquiring another similar story of a student housing property in Kutztown, Pennsylvania, an area we know well. In fact, my wife graduated from Kutztown University. This is also a 2008 vintage 184 unit community that we're going to also open up to both students and non-students and maximize this investment. Coming up behind that, a property I would just spent a Tuesday out at is in Houston, Texas, area at Rolling Brook, 2008 vintage community. Actually, I believe that's incorrect. It's a 2015 community. Some of those stats are from Kutztown, you see there, but it's 2015 built community in Houston, Texas. You see some of the pictures there. Great community that we're purchasing. We think an incredible basis and well amenitized, great team in a growing, rapidly growing submarket of Houston, Texas. So all of those assets are acquired in our $1 billion evergreen REIT. And again, the focus on this strategy is to solve and make an impact on this challenge here. The fact that it is not affordable today for most families to be able to own a home, and in many markets, it's not affordable for the people who live in these local communities to even be able to rent in these markets either. So what is affordable housing? I've been talking about affordable workforce housing. Affordable housing essentially means that a household is able to pay for their housing while still having money left over at the end of the month to cover transportation, food, healthcare, education, the basics that we all take for granted. That's very hard to take care of all those basic essential expenses when more than 30% of your income is going to rent. So we focus on communities where we're not counting on government subsidies, but we're providing housing to working families who are paying their own rent and keeping those rents less than 30% of their income. Right now, more than a quarter of Americans are spending over half of their income on rent. Not 30%, over half. 50% of families are spending more than 30% of their income on rent, which is what's considered cost burden. They're going to struggle and have to sacrifice basic essentials because too much of their income is going to rent. Not to mention, many families can't even find housing that would be cost burden, and they're having to drive 45 minutes, an hour and a half to work because they can't live where they work. What makes this challenging, even more challenging, is that many of the units across America today that are currently affordable are being removed from the affordability pool, either because they're being knocked down and something newer and more expensive being built, or real estate operators are coming in and renovating these communities to a point that they're driving rents up. But less and less units are being built, and more units are being taken out of the affordability pool, driving this crisis at a rapid pace. The best way I like to think about this or sum this up, which I've seen this slide many times, but it still astounds me. If you look at these slides here, you'll see there in 2010, around the middle of that slide, the average rent in America was about $700 a month. That was 10 years ago. In 2021, look at where it is today, $1,226. It's gone up over 70% in one decade. Who listening here tonight thinks that incomes have gone up 70% in that same period of time? Probably not one of you expected that to be the answer, right? Incomes have gone up 4 to 6% while the cost of living has gone up 70%. That's a problem. And that's one that we're really focused on here at DLP as a whole, and certainly here in the Housing Fund. The supply of affordable housing continues to shrink, let alone keeping up with the growing demand. So we're focused on making an impact here. We believe everybody deserves a safe, affordable place to call home, and that's what we're focused on providing. In addition to our work in DLP Housing Fund and in DLP here as a whole in our for-profit world, we're also focused on making an impact through our giving into our foundation, the DLP Positive Returns Foundation. And our giving policy here at DLP is that we give 1% of our time. All 416 of our team members are able to give 1% of their time to philanthropy, to a cause, to a service project that's important to them. We donate 0.25% of all the capital we raise, not from your capital, but from our returns to the foundation. And we donate 0.25% of all of our net revenue as well. In addition, all of the proceeds from Building Elite Organization, my recent book, are also all going to the foundation, which allows us to supplement our for-profit efforts through our foundation. So we are making an impact on the affordability crisis and many other crises, in fact, 3 other specific crises around the country, which I'm going to touch on here briefly. The definition of being an impact investor or making impact investments are investments made with the intention to generate positive, measurable social and or environmental impacts alongside a financial return. So both doing good and generating a great return. Who doesn't like the sound of that, right? Who doesn't want to do good and generate a financial return? And you don't have to sacrifice. You're not sacrificing some returns to do good. We're doing both at the same time. We're focused on making an impact not just on this immense crisis of affordable workforce housing, but also on the jobs crisis here in America, the legacy crisis, and the happiness crisis. We're doing that while generating a 4 times bottom line impact approach, meaning we generate consistent returns to our investors. We provide safe, clean, affordable workforce housing. We grow businesses and create jobs, and we help our residents create wealth and prosperity. Our focus on improving communities is that we're coming into communities like this one you see on the screen, which you're going to see more about in a second. We make physical improvements like painting, roofing, landscaping, parking lots. We add amenities like playgrounds, parks, fitness centers. We improve the management and service. We make sure we put the right residents in place who are going to appreciate and respect their fellow residents. We make the community safe, make it a place that residents can be proud to bring their family and friends to, can feel it's a safe place for their kids to have fun and play. For working class Americans in many communities across the country today. We bring in enrichment programs to help our residents improve their quality of life. We do health and we provide health and education, career advancement, savings, community events, after-school programs, church services. We reduce operating expenses both for DLP and for the residents via green improvements, preventative maintenance, and through lower turnover, keeping our residents, helping them avoid the cost of constantly moving. We help our residents choose to grow their prosperity. And this is important, and it ties in not only with our affordable housing crisis, but also the job crisis. Right now, today in America, 30 to 50% of jobs are at jeopardy of automation in the next decade or two. 30 to 50% of jobs today will likely not be here within the next 20 years due to technology and innovation. That's not all bad. New jobs will be created through innovation and technology, but those jobs will only be created by entrepreneurial small businesses. That's where job creation comes from. And that's what we're focused on through building an elite organization, my recent book, and our efforts through our elite execution system that we're out teaching to the real estate operators we lend to and many other industries as well. Here at DLP, we're hiring over 20 team members every month. We're providing capital support and systems to our borrowers, who we estimate our borrowers today through not only our capital, but through our education of helping them implement the elite execution system, are adding 50 employees monthly today. We're also focused on, through the real estate operations and construction and renovation we do, that's one of the biggest drivers of jobs in the economy today. Through improving communities, improving housing, building new housing creates many jobs. And again, that's the focus of building the organization, the recent book that I published. We're focused on the legacy solution through the DLP Prosperity Family Wealth and Legacy Membership, helping families live and leave a legacy and avoid the generational wealth crisis, the fact that most families' wealth is lost by the third generation. And maybe most important of everything that I'm going to talk about here tonight, and all 4 of these pillars that we're focused on making an impact on, is the happiness crisis. And this is one that all 3 of these other solutions, other pillars drive into. Right now in America today, this is hard to believe, at least it was hard for me to believe when I first heard these numbers. Well over 40% of Americans today are suffering from some form of mental illness, by far the largest being depression. And we're focused on helping people achieve happiness through living fully and in turn achieving significance, making an impact, and having a deeper relationship with the Lord, our Creator. And we believe that it's our job as leaders of organizations to help our people gain the feelings of importance and significance from their work, being connected to an organization that's bigger than themselves, that's making an impact, and then take that feeling of value and significance that strive from their work and carry that into all aspects of their life. And that's a big part of what we teach in the elite execution system, what we teach and help implement in the companies we're coaching and consulting and helping around the country today. In an effort to continue to grow our ability to make an impact, in actually the next couple of weeks, we are launching a podcast called Impact, focused around these 4 crises. And we hope you'll listen in. We have an amazing group of thought leaders and experts who are joining us in our episodes that we're in process of recording right now and about to launch. We're going to start off with a focus around this jobs crisis, and hope you'll join in and listen. It's going to be pretty amazing. So I'm going to give you an example of some of the impact that we're focused on making. This is a community called Prosper Azalea City. It's a community we bought a couple years ago in Valdosta, Georgia. It was in need of a lot. It had about 50% occupancy. It was in bad shape. There were some crime issues. It had been neglected. The pools had been down for years. Had a lot of challenges going on. And we've come in and made a pretty tremendous impact on it over these last few years, more than doubling the value while creating a great place for our team members to work and for our 850 residents in this community alone to live at. I'm going to let the team members and residents tell you a little bit about this themselves.
We really try to give every resident a wow experience, not only from just the initial application process, but the move-in process, and then of course once they become a resident, we want them to enjoy living here.
I've always been used to just like going somewhere to just pay my rent and that's it, or like paying it online. Here, anything that I need, I've been able to text them or even just call them and they respond super quickly. They're very, very accommodating to everything that we've needed so far. I feel at home, like it's only been a short time, but I feel at home here, especially coming to my apartment. It's just a nice, homey feeling. It's a warm feeling.
Ever since they took over, I've had nothing but nice things to say about them. The maintenance team is amazing. Usually when I have issues, the next day they're in my apartment fixing it. The ladies in the back office, if I ever have any questions, I can call them and ask them whatever I need, and my dog loves them. No, it's been nothing but good things since they took over.
I see people here that lived at properties that I used to work at, and they see my face here, and they talk about how much of a change the area is. The units look good. The curb appeal is improved.
The property has done a full 180 turnaround. We have increased occupancy from high 50s to almost 100% in a little over a year. Our financials are excellent. We are cash flowing, so we are operating as we should.
And we've all really just enjoyed it. Like I said, we've enjoyed being here in like a smaller town and just the people, like the Southern hospitality. We've never experienced that in Miami. So it's been such a nice feeling, and I'm really gonna miss it now when I leave.
DLP as a whole has been very good to myself and my family. We're all successful, and if we're not successful, DLP will find out a way to make us successful. I've never worked for a company that is as dedicated to their employees as their employees are dedicated to them, and it's definitely nice to get a attaboy, pat on the back, especially from all the way at the top. Don himself isn't afraid to shake a hand. He's not afraid to show his face, and it means a lot.
All right, so they did a much better job than I ever would have done to show you the impact that you guys are making as our investors. This is a community owned in the DLP Housing Fund, providing housing to 850 residents, rents from $700 to $1,050 a month. Despite everything you heard and the amazing progress we made in that community, and as great as it looks, our rents are still less than 30% of the area median income, while providing enrichment services, pools, playgrounds, dog parks, and great service to our residents. So what's amazing is, despite all that, we're not coming and saying, all right, in order to do all this good, you're going to have to sacrifice and not be able to generate great returns. In fact, our returns in the DLP Housing Fund and all of our funds are tremendous, I think, by most standards. So take a look at this little chart here. If you invested here and we achieved just our target returns in the housing fund, not what the returns we've actually been hitting, you invested $250,000 and had those distributions reinvest, as you have the option to do in all of our funds at DLP. Look at the amount you'd earn in the first year of $30,000, and $36,000, and $39,000, $43,000, $49,000, $56,000. You would earn $255,000 on that original $250,000 investment, more than doubling in 6 years at our target return. Pretty amazing, while making an outstanding impact on hundreds and actually thousands of residents. So in addition to our efforts of making an impact through our direct investments, such as Prosper Azalea City, we're also making an impact on investing in workforce housing and on jobs through the lending we do. Many of the great borrowers we lend to are also investing in providing workforce affordable housing and scaling their business using the elite execution system. So far, in the past 6 months, we've originated over 313 loans for over $265 million to our elite members who are in the progress of implementing the elite execution system into their businesses, dramatically growing the number of jobs that they create directly in their company and through the investments that they make. Part of this, and this is a big reason to why I wrote Building an Elite Organization, which I'm proud to say is now an Amazon bestseller, and is on progress to be a bestseller on the Wall Street Journal and some other books. And way more important than the awards is that it's getting in the hands of those who need the content and are serious about scaling a great business, providing jobs and making an impact. You see some of the great quotes there. You see a pretty amazing gentleman there, Horace Schultz, author of Excellence Wins and the co-founder of Ritz-Carlton, wrote a really amazing endorsement there for the impact of building an elite organization. Along with the book, we have our elite journal. Everybody who joins us in July will be providing these out to you as well. And anybody interested in getting a copy of the book, a signed copy of the book, shoot your investor success manager a note, and we'll get one out to you as well. Love to get your feedback, and love for you to get in the hands of anybody you know who's looking to make an impact and scale a high growth organization. We're proud of the impact. What the book is about is our elite execution system. And we know that the companies who are serious about putting the discipline in place of running the elite execution system will be able to generate consistent results and in turn create jobs and make a tremendous impact. Our real estate operators we lend to are doing so, improving communities, creating workforce housing, building jobs, all while reducing our risk in investing capital with them. So speaking of all the impacts we're making, let's get into what our results were in Q1 for you as our investors specifically. So in the DLP Housing Fund, we achieved our 6% monthly preferred return distributions, and we sent out the excess distributable cash. All the returns we earned over 6% in 2020. We generated a 13.94% return in 2020 in the middle of COVID in the DLP Housing Fund. Pretty impressive, I have to say, and I say that humbly because the amazing results of our team members are like the team members you saw on the video, who are out there, who provide a great service in residents' homes all through COVID, continue to service our residents, collect our rent, generate great returns. The DLP Lending Fund generated 11.07% net return, all distributed to investors. The Income and Growth Fund, very similar, 11.12% distributed out to investors. Equity Fund 2 hit its preferred return out to investors and is in process of winding down and generating great distributions out to our remaining for all the remaining capital in the Equity Fund 2 as we go through our wind down process. The DLP Fixed Fund, 11.92%. And then, of course, all of our fixed note investors received the exact fixed return that they locked in on their fixed note, ranging from 5 to 10%. So all of this today, all of those returns hopefully grab your attention, but even more so, hopefully the impact that we can make together grabs your attention. You can invest with us today through the DLP Housing Fund I've been talking about. You see some of the slides here, 12% return target, 6% preferred return that you earn before we earn anything. We don't even earn a management fee. Generated nearly 14% last year. We're on path to grow this fund to provide housing again to more than 250,000 residents. We want your help in doing so. On the lending side of our business, we had amazing performance through COVID as well, record-breaking originations while having no default loans all through COVID, despite the moratoriums, despite construction shutdowns. Our borrowers continued to make their payments, continued to perform, and we continued to support them. The DLP Lending Fund has hit a 13+% return over the last 7 years, net to investors. Our positive note investors have received their fixed returns, depending on locking in either. You can lock in just a 90-day note, meaning it'll be evergreen. You can redeem anytime with 90 days, or a 1, 3, 5-year note and get the fixed return on that screen take distributions monthly, or let it compound and get the great power of compounding returns. And last but certainly not least, we have our DLP Income and Growth Fund, which has generated over 12% return since inception, continuing that great consistent returns out to investors each and every month. So if you want more information about any of our funds or how we're making an impact, reach out to Larry, Mike, Rich, Bob, Brett. They'd love to chat with you, love to help, love to see how we can be of value to you, to your family, in your path and your journey of making an impact, as well as certainly helping you generate great returns, consistent distributions across our various funds. So with all that said, it is time to open it up to all the many questions I know have been coming through throughout the presentation. So Rich and Larry are going to be manning the questions, and look forward to the opportunity to answer any and all questions here tonight.
Excellent. Good evening, everyone. Don't forget, put your questions in the chat box. We're going to ask them, and we have a few we're going to start with. The first is coming from Shane. The question is, with sales of properties, do you 1031 into new properties, or does that sale cause a taxable event for investors? Great question, Sean. Thanks.
Yeah, thank you very much. Great question. So I assume the question was in the DLP Housing Fund, where we own apartment communities, rental communities. As we sell those communities, even though this is an evergreen fund and we'll operate it for decades, we do sell properties throughout the duration of the fund. When we sell those properties, we are able to do 1031 exchanges, meaning we're able to defer the taxable gain while realizing those actual gains to our investors. One of the many reasons why the housing fund is arguably the most tax efficient investment vehicle you can invest in. Certainly they'll generate double-digit returns.
Excellent. Thank you very much. And we do have a follow-on question from that for Danielle. She says, what are DLP's thoughts on the potential changes to the 1031 program by the new administration, and how might that affect investors?
Yeah, that's a great question. And look, there's a lot of potential changes to tax, right? There's concerns about capital gains tax, about 1031 change, about estate taxes, right? There's a lot of potential changes. I do not believe we're going to see any significant changes to the 1031 rules. I think that's very unlikely. Not that I have a crystal ball, but the positive I'd say, if the rules do change, anytime there's significant change in tax law and policy and the economy, it creates volatility, and volatility creates opportunity. So if all of a sudden there's going to be a major change where the 1031 is going to sunset, well, guess what's going to happen? A lot of investors are going to urgently be looking to sell, which is going to create some great buying opportunities. And for us at DLP, one of the great benefits of having an evergreen fund is if the 1031 rules change, they will likely only change for an administration. You may then decide not to sell assets over that period of time. Wait for the rules to change once again, if that were to happen. So we'll adjust what we do and how we find inefficiencies in the market based upon what the changing variables are.
Excellent. Thank you very much. We have another question from Rick. The question is investing in student housing a new thing for DLP?
Yeah, great question, Rick. And we've invested on a small scale in student housing for many years. We've done a good amount of investment sales and brokerage for a number of student housing operators. So we're certainly familiar with the space. Actually, Bo Parfit, our chief growth officer, actually had a large student housing portfolio and before his time at DLP, and many of our leaders in DLP property management and construction management come from deep student housing backgrounds. But in short, yes, it has not been a core focus here at DLP, and frankly, it's still not a core focus here at DLP. We're acquiring those 2 student housing communities, but in short, we're just simply opening up a student housing community to all residents. So it happens to be in those markets that there's a lot of students because they're homes to universities, but we'll still be renting our apartments monthly to full-time residents, whether they're undergrad, graduate students, or non-students. But by having a strong, growing university in a local area, it provides a great source of jobs and residents, which is a great thing in all cases.
Excellent. Next question is coming in from David. How does the Income and Growth Fund we've heard about generate returns?
Yeah, great question. So Income and Growth Fund, in short, is a lending fund. So all of the assets are loans, just like the DLP lending fund. So it's very, very similar in this type of format. Probably not have the time to go through all the nuanced differences, but it's a lending fund. All the income is interest income made on short-term loans to real estate investors. just like the DLP Lending Fund and the Positive Note Fund.
Excellent. Thank you again. So a question from Steve. He would like to know, how's the bank acquisition progressing and how will you use it?
Yeah, thank you. So yes, it's been on quite a bit of news and out there that DLP is, or I should rephrase, I am in the process of acquiring a bank along with many of our investors who have signed up to be shareholders in the bank. So we are in active process. We are very close to being at the point of full application, full submission to the regulators and moving forward towards closing. So we're still on timetable today, likely 4 to 6 months until we close. But we think the bank fits really nicely with the value we can provide to all of you. So obviously, many of you are invested with us in our investment funds already. We want to be able to provide you full banking services, but provide you competitive rates on your deposits, phenomenal service and technology on your banking needs, in addition to be able to provide services from wealth management and trust services, which will be an arm to the bank as we launch it. So we think it'll be very complementary, and it'll help us grow our lending book and balance sheet, as it'll allow us to provide a little bit more cost-effective capital to bigger real estate operators to pick up some of the business we can't generate in our funds, while driving the business that does fit for our funds into the DLP Lending Fund, Income and Growth Fund, Positive Note Fund. So it's going to fit really nicely in expanding our capabilities and our resources, both for the operators we provide capital and resources to, as well as the families who invest with us.
Excellent. Another question coming in from Thad, and he says, hello, Don. So Don says hello. And again, he would like you to comment on the eviction ban and how the recent court decision that it's unlawful may impact DLP.
Yeah, it's a complicated topic, Thad, in that there's been multiple different kind of court rulings saying it's unlawful, and it continues to get batted around. But the problem is that it's really being enforced at a local level. So it's really up to the local judge, really, how they determine they want to enforce it. And in some, as crazy as it may sound, we've had situations in the same district, in the same county, one judge enforces it and another doesn't. And that's the challenge we face, is it's really up to the local judge in most cases. But the good news is that employment's rising, and our residents are making payments. We've had no problem finding residents who have gainful employment to move into our apartments as well. And more judges and more areas and states are beginning to move forward with eviction. So I think rulings like that coming out just provides these judges with more ammunition and confidence to take action and support landlords in being able to move residents out. And then there's also been a lot of great, I have to mention, there's been lots of great local and statewide aid programs out there as well, designed to help residents. And it's an area we've taken tremendous action on. I give our team members in property management tremendous credit. They've worked tirelessly to find resident assistance program, government aid out there that can help those residents who legitimately have had effects of job loss to be able to come up with aid. And it's been very, very helpful in many areas.
Excellent. Thank you again. So we have another question coming in from Gabriel. He would like to know, he says the housing fund has participated with minority participation on some properties, some as low as 7%. What is the policy on participating as a minority, and who owns the remaining?
Yeah, great question. So most cases, the investments we make today in the DLP Housing Fund, the housing fund is typically the majority investor. The other investors in a property we acquire are generally three different possibilities. Number one is myself or my family trust invests in every one of our acquisitions. Two is DLP ourselves, DLP Capital Partners invests in every one of our acquisitions. And then third is some of the properties we bring forward, we have a operating partner, a sponsor who is the one who found the deal, put the deal together, who invests alongside DLP and the DLP Housing Fund, generally subordinate to us as investors, meaning we get our returns back before they do. So those are the other components that can bring the capital forward. And what really drives how much the capital goes in, it depends upon the capital in the fund. When we have large amounts of capital, as we've had coming into the fund, we try to give the fund as much of the deal as possible to deploy your capital as quickly as possible, but making sure that myself and Bob and Barry and Rich and the team here, that we're investing alongside our investors, putting our money and our support behind these investments, alongside our investors. And we do that on every single community we buy.
Excellent. Thank you again, Don. Coming in from Jonathan, has asset revaluation changed the share price? So I'm assuming this is in connection with the housing fund.
Yes. So in the DLP Housing Fund, one of the unique parts of the housing fund is because it's an evergreen open-ended fund, we have to go through and every year come up with a NAV value, a current value of the underlying assets. And we do that so that the existing investors can realize those values and be able to then in turn exit the fund if they so choose. And then we also have to set a new value so that new investors come in based on the current value, making it fair to the existing investors. So yes, last year, a portion of the excess distributable cash that we earned, or the additional distribution that came here in Q1, was made up both of realized gains from operating income from the sale of properties and through the increase in value of some of our assets through the efforts we make through renovations, through management, through improving the value of these assets, in addition to, in some of the cases, market compression as well. One of the very unique things, though, about how we go about our valuation process is you as an investor will be able to realize the gains of property values going up, but we at DLP do not. And what I mean by that is we figure out what our percentage of the profits are for the increase in value, but we never get to take $1 of profits until those properties are sold and the profits are actually realized, which is very unique, making sure we're only ever earning money on realized gains.
Excellent. So we've got a ton of questions coming in. I'll just keep urging you, keep them coming. We love all the good stuff coming through. So the next one is from Steven. He would like you to please compare and contrast the lending fund with the income and growth fund.
Yeah, great question. And I'll keep it, just a little bit high level, but really it is for the most part a high level kind of conversation. So in short, mechanically, they're very, very similar. Both have 10% preferred returns. Both have 10% return targets. Both are generating over 11% returns. Both of them pay out that preferred return every single month on the first of the month. The lending fund also pays out all additional distributions the middle of every month. The income and growth fund pays out all additional distributions once a quarter. They're both lending funds, both lending predominantly on workforce housing. Income and growth fund has more of the loans against properties that DLP has some ownership interest in, often in a partnership with one of our best operators. And the lending fund has a smaller percentage of properties in which DLP has some ownership level. The bigger reason, I think, really where the question really is driven to is why does somebody choose the lending fund or the income and growth fund? The most common reason that somebody chooses the income and growth fund over the lending fund or vice versa, we find to really be about deployment and which fund is going to deploy their capital the quickest. Because they're both so similar, generating such similar returns, that's often the decision maker. And we always do our best to give you that expectation of how long it would take it to deploy your money in the lending fund versus income and growth. And generally, the income and growth fund is faster, in part because we have not been marketing the fund as much, and it's a little bit newer. So those are the high level overviews. There's some other technical differences that could make a difference to you or not, such as the lending fund is a private REIT and the income and growth fund is not. And there's a couple nuanced difference. And then the other factor that some will choose one of the overs is we do expect the income and growth fund to slightly outperform the lending fund in terms of its total return.
Thanks again, Don. So again, we're going to keep these coming. I'm urging everyone also, if you have questions after the Q&A, myself, Larry, Bob, Mike, Brett, all of us are going to be around. You can call us. Kyle will throw up the main number to dial us on, as well as Larry will put in the chat box there for you. Connect with us. We're happy to answer all your questions after this if we don't get to them, but we're going to take a few more and try to go a little bit more rapid fire since it's now 7 o'clock and we want to be mindful of all your time. So quick one, does DLP own any 55 and older communities?
We do not today.
Not today. Beautiful. Okay. Is the bank acquisition closed to investors?
So we've made the bank acquisition available to our Inner Circle members and Prosperity members. So if you're an Inner Circle or Prosperity member, reach out to us. We have already achieved our goal of how much capital we want to raise. We did that in just a few days of opening it. We could potentially take in a little bit more capital as we finalize the business plan, but it is only available to Inner Circle and Prosperity members. If you're interested in investing in the bank and or interested in becoming an Inner Circle or Prosperity member, reach out to one of these handsome gentlemen on the screen and they will chat with you about that.
Excellent. Great question here from Whitney. Can you talk a little bit more about the deal pipeline for the housing fund and projected purchases and goals for the remainder of 21? Is the pipeline steady, growing, or diminishing?
Yeah, great question. So, it certainly ebbs and flows a little bit in terms of the number of deals we have under agreement, but I'll say in short, it's steady. We acquired 1,900 units in Q1. Here in Q2, we are looking like we'll close about 800 units, which is more than our quarterly goal. And we have a big pipeline of deals we're working on. So it'll ebb and flow from quarter to quarter as these are large transactions and it's a little lumpy when they close and they can move a month easily due to a variety of reasons. But pipeline's very strong. We feel very confident we'll be able to continue to deploy the capital at the pace it's been coming in, which has been record breaking and amazing. Thank you again to all of you.
Great. Another question from Shane. Does DLP manage the local operation of the property or not?
The majority of them we manage, but when we do partner with a great local operator, if he is integrated and runs a management arm to his business, we do allow them to do the management with the ability to step in and manage if we so feel we need to. The majority of our portfolio today, we are doing all the hands-on management.
Excellent. And I love a good softball question when it comes in. For the lending fund, what is the rate of default and what do you do to the notes that have gone bad?
Yeah, so the overall default rate of the fund is a little bit, I believe, under 2%, 1 point something percent today. We have had 0 new defaults in over a year. I would consider 2 to 3% to be very good in a fund like this. Having some level of default is typical in a lending strategy. And it's typically just cash management challenges that operators who have kind of lumpy cash flow are challenged with. But we've had no new defaults. When we get a loan that goes into default, we have a whole servicing team, including a legal arm to that servicing team, that works aggressively, proactively with the borrower to work on finding solutions, to work on helping them figure out forms of liquidity, how to get the project done, how to get the project sold. Most cases, they simply resolve themselves through sometimes help. Sometimes they get stuck in construction and we help them resolve that and find a contractor, an expert, or a vendor. But more times than not, they get the property on the market and sold in a 60 to 90 day window. If we get into a situation where that doesn't happen and borrower becomes non-responsive and we take full legal action and we file a judgment and we go forward with foreclosure and we'll take the property all the way to sheriff's sales if we so need to. Hasn't happened often, but when it does, we do so. And one of the unique things we do, and we probably haven't talked about this in a little while, one of the unique things, because we haven't had any defaults, but one of the things we do is we actually will purchase that property from the fund, or that loan, I should say, from the fund prior to having to own the property. And then we handle that work out ourselves. When I say we, basically mean, I purchase that property, handle the resolution. And keep in mind is that here at DLP, we will this year acquire 5,000, 6,000 residential homes. So acquiring a home or a property that goes bad is not a challenge to us, not something that's new to us. We've actually in the past bought large tapes of hundreds of distressed loans and worked them out and acquired the property, something we know how to do and we're very comfortable doing if we have to.
Excellent. Thank you again. From David, when an investor exits the housing fund, how is that treated for tax purposes?
So when you exit the housing fund today in the current tax situation, those gains are going to be long-term capital gains. You will have recapture of that depreciation, so that deferment that you had over the course of the fund. But in short, I think the short answer to that question, we could get into more nuance, is for most, historically and today, you're going to be taxed at a much lower tax bracket than you're taxed at your marginal tax bracket for most of us. So it's very, very tax efficient. You get the benefit of deferring that tax for hopefully years, getting to earn money on your money. while then when you do pay taxes and you choose the timing of paying those taxes, you're being taxed at long-term capital gains.
Excellent. And we're going to take one more question here. And then again, you can call any of us on the screen. We're happy to help you out, answer any questions. From Todd Silver, he likes to know if you can talk a little about larger goals for the company and total loan volume, the increases for the year, how you expect that to impact profitability, impact investing, and new operator relationships.
That was a big one. Thanks, Todd. So in terms of our lending business, which I believe is where all those questions were essentially around. So one of the things last month, we just went over this actually this morning. Last month, the month of April, 83% of all the loans we closed were to repeat borrowers, which is a pretty consistent number for us. We do a great job of building deep relationships and retaining them. At our upcoming event, one of the things I didn't talk about at the upcoming Prosperity event is not only do we have families like many of you who are going to be there focused on living and leaving a legacy, we're going to have our best real estate operators and potential real estate operators there as well. We expect we'll have over 100 real estate operators and some of their teams there focused on it's a mastermind and workshop event that we do with them, helping do masterminding about investing in real estate and workshopping around how to scale a great business, hire great people, put discipline in place. And that leads to a jump off point with many new relationships where we build deep relationships and become their lender and capital partner of choice. So we're focused heavily on building that network of these operators are all operators who are own typically over 1,000 doors, typically own over 50 million of real estate, are doing 50 plus transactions annually, typically have 25 plus employees and rapidly growing. These are high quality operators, strong net worth, cash, experience. These are the operators we're really, really focused on, and we're actively building that base of borrowers, and that's becoming a bigger and a bigger percentage of our loan volume. So when we started this year off, we set a goal of originating $500 million in loans here in 2021. We are well above that pace already, so much so and so confident with the efforts we made in building our team and the progress we've made here that we actually just officially internally have, and I'll go ahead and announce this, that we raised our bar and said from Q2 this quarter to Q1 of next year, we're going to originate $1 billion. So we've dramatically raised that bar, and we've got very clear milestones to hit each month to kind of hit that growth, which is what we need to do to continue to deploy the capital that you guys are entrusting to us. And we're very excited we'll be able to do that while continuing to hit these very consistent returns and continue to increase the quality of our average borrower.
Excellent. And with that, we're going to go ahead and wrap up the Q&A session. We are getting some questions about Prosperity membership, about Inner Circle membership, and we urge you to reach out again to your ISM. We do have another webinar coming on June 17th, but the big event live in Asheville, July 8th through the 12th, we urge you all, register, go online, come up and get involved. We're going to be there live. We're going to have over 150 folks on the Prosperity side. We're going to have over 100 folks on the Elite membership side. So you'll get to meet not only the top investors, but the top operators. So again, we look forward to seeing you all. And with that, Don, I'm going to let you wrap us up here. Thanks.
Thank you, everybody. Really appreciate you staying with us here tonight. Hopefully brought some value to you. Thank you sincerely for your support, for all of you existing investors and those not yet invested with us. Thank you for giving us the opportunity to learn about us and see if we're a potential fit for you and your family to make an impact, generate great returns, and hope to see many of you live in Asheville in 2 months. So thank you, everybody. Cheers.